Japan just lit a fuse under the global markets, and most investors haven't even smelled the smoke yet. In the last few months, Japanese bond yields have ripped to levels we haven't seen in decades. And that one move is quietly pushing up borrowing costs around the world. If you own US stocks, global bonds, or you think your portfolio is diversified, Japan is now your problem. Stay locked in for the next 10 minutes because I am Jin Wealth, and I'm going to show you how Japan's rising yields can shake your net worth and how you can prepare before the main shockwave hits. Welcome back to Success Symptoms, the channel where we turn macro chaos into manga-style money moves. For 30 years, Japan was the kingdom of free money. Zero or negative interest rates, experimental yield curve control, and a bond market that barely moved. That era is officially and completely over. In 2024 and 2025, the Bank of Japan finally abandoned negative rates and started lifting policy rates off the floor, taking its short-term rate up towards 0.75%, the highest in roughly 3 decades. By 2026, the 10-year Japanese government bond yield is trading around the low 2% range, near multi-decade highs, and long-term yields have surged even higher as investors demand real compensation for inflation and fiscal risk. That may sound like small numbers, but for Japan, this is a regime change, and regime changes don't stay local. Let's break down what actually changed on the ground in Japan. First, inflation. After decades of fighting deflation, Japan is now dealing with persistent price pressure, helped by higher energy costs and global supply shocks. The Bank of Japan has raised its inflation forecasts and openly signaled that the days of ultra-easy policy are fading, even if rates are still low compared with the rest of the world. Second, policy rates. The BOJ has hiked its short-term policy rate multiple times, from the old negative zone to around 0.75%, and markets expect the path to stay tilted toward gradual tightening if inflation and wages hold up. Third, the bond market itself. The old yield curve control framework where the BOJ essentially capped the 10-year yield has been dismantled, allowing yields to move more freely and forcing real price discovery for the first time in years. The result, the 10-year JGB yield has pushed into the 2% to 2.4% area, and super long JGBs are trading nervously at multi-year highs as traders test how far they can go before the BOJ steps back in. In Japanese terms, that's not a tweak, that's an earthquake in slow motion. Here's the part global investors can't ignore. Japan is one of the biggest creditors in the world, with roughly $1.2 trillion in US treasuries alone as of late 2025, plus massive positions in European bonds and other foreign assets. For years, Japanese banks, insurers, and pensions were practically forced out of their home market because domestic yields were pinned near zero, so they hunted yield overseas and helped keep global borrowing costs low. Now that domestic yields are finally attractive, they don't need to go as far. Every uptick in JGB yields makes it easier for a Japanese institution to say, why take credit risk abroad when I can earn something at home? That shift means less automatic Japanese demand for US treasuries and European bonds, so a bigger share of new issuance has to be absorbed by more price-sensitive investors at higher yields. Higher equilibrium yields, independent of what the Fed or ECB are trying to do, are a structural headwind for long-duration assets globally. Now let's talk about the shadow beast, the yen carry trade. For a long time, the recipe was simple. Borrow in yen at near zero rates, convert into dollars or euros, and buy higher yielding stuff like treasuries, credit, emerging market debt, or even equities. It worked because Japanese rates were anchored. The yen often trended weaker, and volatility stayed contained. But when Japanese yields rise and the BOJ hints at more tightening, that math flips. Borrowing in yen gets more expensive, the yen can strengthen, and suddenly those leveraged trades don't look so safe. If enough players unwind the carry trade at once, they have to sell those foreign assets, pushing global yields even higher and hitting risk assets in a wave, not a gentle tide. We've already seen episodes where stress in Japanese bond auctions and spikes in long-dated JGB yields coincided with global risk-off days, weaker US bond auctions, rising long-term US yields, and sudden drops in equity indices. So when you hear Japan yields are up again, translate that as someone somewhere may be forced to delever right now. Let's connect this to what you actually own. On the bond side, higher Japanese yields contribute to a global repricing of long-term rates, especially at the 10-year and 30-year points. Long-duration bonds, the stuff with big interest rate sensitivity, are the first in line to get hurt as yields grind higher, and weaker credits can see spreads widen when global liquidity feels tighter. On the equity side, sectors that thrive on cheap money, high-growth tech, speculative stories, and heavily leveraged companies are most vulnerable to a world where the free money anchor in Japan is gone. We've seen days where higher Japanese yields correlated with pressure on growth stocks, rate-sensitive sectors like utilities and REITs, and anything crowded in the global carry universe. Meanwhile, certain Japanese financials and domestic lenders can actually benefit from a steeper curve and positive rates as they finally earn more on their core lending. So this isn't just bad news. It's a rotation story, a repricing story, and a test of who depended on free money without admitting it. Now, how are sharp investors preparing for this new Japan-driven environment? First, managing duration. Many are shortening the duration of their bond exposure, shifting toward short to intermediate term debt instead of loading up on 20 and 30-year paper that gets crushed when yields jump. Second, upgrading quality. With global capital flows in flux, balance sheets matter again. Investors are tilting toward companies with strong cash flows, manageable leverage, and pricing power instead of pure multiple expansion stories. Third, watching currency risk. Rising Japanese yields and potential BOJ tightening can make the yen more volatile and possibly stronger, which can amplify losses for anyone who borrowed in yen or left FX unhedged. Fourth, hunting selective opportunity. As yields normalize, Japanese government bonds and some domestic financial names can become interesting for income and value investors who believe in a more sustainable, normal rate world in Japan. At the same time, global assets that were priced for an endless era of suppressed yields may still need to adjust downward, especially in the longer duration, story-heavy corners of the market. Preparation here isn't about panic. It's about positioning your portfolio so that Japan's transition is a wave you surf, not a wave that wipes you out. If you're serious about using this theme instead of getting used by it, here are the signals I would keep on my screen. Number 1, the 10-year JGB yield and the behavior of super long JGBs. Nervous trading and failed auctions are your early warnings. Number 2, BOJ meetings and guidance, especially any shift in how they talk about inflation risks, wage growth, or the pace of future hikes. Number 3, cross-market reactions. When JGB yields spike, watch how US long-term yields respond, what happens to USD/JPY, and how global equity indices behave that same day. That triangle, Japan yields, the yen, and global risk assets, is where you see whether this is just a headline or a real portfolio event. Japan's rising yields are not a side quest. They're one of the main storylines in this cycle. If you want more high-tempo, manga-style breakdowns on the moves that quietly move your money, hit subscribe, tap like, and drop Japan Wave in the comments so I know you made it to the end. I am Jin Wealth from Success Symptoms. In a world where everyone watches the stock tickers, we watch the bond market plot twists. Stay sharp, stay solvent, and I'll see you in the next episode.